Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. I am on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about the tax implication on insurance proceeds when you file for a claim. A lot of people are under the perception that when you file for an insurance claim and you get a bunch of money from insurance company, you don't have to pay any tax on it. But is it true? The truth of the matter is that there are many different types of insurance and many different types of insurance claims, and certain type of insurance claims do not trigger any tax implication for real. But if you are real estate investors like I am, if you file, you suffer from any damage from the tenants or suffer from any flood, any fire, any damage from having your house burned down, some of these insurance reimbursement may trigger tax implication on your personal tax return or corporation tax return, depending on how you own your rental properties. Now, we are going to use today's video to dive deeper into the insurance proceed implication. But before I get started, make sure that you hit the subscribe button below and give us a thumbs up if you like the video and if you like to stay on top of the latest tax implication. There are two components when it comes down to insurance claim. When you are suffering a loss caused by fire damage or flood damage or any other damage, your tenant destruction damage, there are two components when it comes down to insurance claim. The first one is that the insurance, depending on your policy, the insurance company may pay you an amount equivalent to the loss of rent that you would be suffering during the period of repair. So that's the first component. The second component of your insurance claim is just reimbursement to replace the property or reimburse the expenses that you would incur to repair the property and bring it up to that standard, original standard. So those are the two components of your insurance claim. Now, once you get the money from the insurance company, depending on what you do with your insurance proceeds, the first component, the loss of rent component, has to be reported as rental income on your tax return. You can deduct all the related expenses that you incur during that year against that loss of rent, but you will have to report that rental insurance proceeds for reimbursement of loss of rent as your rental income. Now, on the other hand, if you receive insurance proceeds to reimburse for the damage that's caused by your property, and depending on the amount, the extent of damage, and the amount of repairs that you are doing, if you're rebuilding up the entire property versus if you're repairing your current property, we may have different treatment under the Income Tax Act. So let's go through some examples to explain the intricacies of these two components in terms of tax implication. So recently we have a client who has his property completely burned down, unfortunately, in a not so nice area. So he decided not to rebuild the property. And in his particular situation, using an example, some sample numbers to illustrate the tax implication, he received $700,000 from the insurance company as a reimbursement for his loss of rent as well as the rebuild costs for the building. Now that's $700,000 in total, out of which $50,000 represent the loss of rent. And that $50,000 loss of rent would be then reported as income. Now, the remaining $650,000 is meant to be for him to spend on rebuilding the property. And if he chooses not to rebuild, as in the case in my client's case, not to rebuild the building, so what's going to happen is that when he received the money, he would have to report a deemed disposition of the property because he no longer owned that building. And as a result, let's say he purchased the property for $400,000. He got insurance money for $650,000. So the delta of that $250,000 is capital gain, is being reported as capital gain. He would have to pay capital gain tax on 50% of the $250,000, which is $125,000. Now, if he's not building, that's only assuming he's not building or repurchasing another property. That's the tax implication. Now, what if he's using the proceeds from the insurance to purchase another property within 24 months? And then there is something called a replacement property rule that could potentially get him exempted from paying taxes in the first place when the property is deemed to be disposed when he received the money. So if he purchased a qualified property to replace the original property within 24 months after he received the money from the insurance company, then with the approval from CRA, he may be able to defer the capital gain he incurred on the first property, original property, until at the point when he sells the second replacement property. So that could be something that you can keep in mind of. Hey there, sorry to interrupt the video. I know you're learning something valuable, and I love sharing strategies to build wealth and achieve financial freedom with you. But if you want to learn even more wealth building strategies from top experts like Derek Foster, Jesse Itzler, and if you want to achieve financial freedom faster so you can finally live your best life, then I highly recommend that you save your seat at the upcoming Wealth Hacker Conference that's happening on November 12th, Saturday, 2022, live in Toronto. Whether you are a real estate or stocks geek like me, or you are a crypto head, or even a business owner or aspiring entrepreneur, grab your tickets now because we'll be sharing all the best practices for building wealth across these asset class at the Wealth Hacker Conference. Come November 12th, live and in person in Toronto. But what if he's rebuilding a property? He's using that $650,000 replacement property from insurance company, $650,000 claim from the insurance company to rebuild. Now, let's say he only need to rebuild for $600,000. He only spent that $600,000 on rebuild. He's able to find some saving. It's not $650,000, it's only $600,000 that he's spending. But he got $650,000 from the insurance company. He's essentially ahead by $50,000. In that case, that additional $50,000 that's ahead is being used to reduce the original purchase price of the property. In our client's particular example, his original purchase price of the property was $400,000. Now, because he spent $600,000 on the rebuild, the actual cost of the rebuild is $600,000. You need to add that $600,000 to the cost of the building. Now, because he got money from the insurance company of $650,000, he then needs to subtract that $650,000 against his purchase price of the property and plus the additional cost to rebuild. So the net revised adjusted cost base for future sale calculation would be $350,000. The original $400,000 purchase price minus the $50,000 that he's ahead between collecting the money from the insurance company and the actual amount that he spent on rebuilding. So his purchase price would then be reduced by $50,000 and become $350,000. When he sell the property 10 years down the road for $1 million, you take that $1 million minus $350,000, the delta is then subject to capital gain tax. But what if your situation is less severe than having the entire house burned down? And what if your situation is similar to what I experienced twice in my whole career as a landlord? What if you just have a basement flood and you had tenants moving out temporarily and you had some loss of rent? What's going to happen in that situation? Well, like, we still claim insurance. We have to pay our deductible. We have insurance company usually have a minimum deductible. If the more amounts that it is deductible, meaning that the insurance company is not responsible for, then the less the insurance cost would be, the annual insurance cost would be. So we have a $5,000 deductible on the flood. And what it means is that for the first $5,000 worth of damage, I would have to come out of my pocket. So in our particular situation, we spent about $10,000 on repairs. We had a restoration company to take all the walls out so that the house was not molded. So that restoration company charged us $20,000, and they didn't charge us directly. They charged the insurance company directly. So the insurance company actually paid them that $20,000 directly. And the repairs cost us about $10,000. So we had to come up with the $10,000, and there is a loss of rent of about $8,000, 3 months worth of rent that was lost. So we have a claim of about $18,000. But instead of writing us a check of $18,000, the insurance company wrote us a check of $13,000, deducting the deductible amount. So how do we account for this type of complicated money transfer in and out? So first of all, the deductible is meant to be for the repairs, because I incur the deductible because of the repairs that I have to pay. So then this deductible would be offset against the repair expenses that I have, which is the $10,000. So $10,000 minus $5,000. This $5,000, because the expenses that I incur on repairing the property to get it back to the original shape, they're considered current expense. And so I would be able to deduct that $5,000 against my regular rental income. Now, in terms of the loss of rent, that $8,000 I got from the insurance company, it would be reported as part of my rental income, and I take that $8,000 added to my rental income. And that's how you would report properly, how you would report the insurance proceeds on your tax return. Now that we have covered all the nuts and bolts of the insurance claim and tax implication of what you would have to do when you're suffering a loss and when you're paying out the repairs or replacement costs, if you like this video, make sure you give us a thumbs up. Until next time.